Hello, everybody. Welcome to today's session of investing. And in today's session, we will be learning about three things. First one is what is different kind of investing, that is small cap investing, large cap investing, or mid cap investing. The second one is we will be having a quick comparison between the differences between small cap investing versus large cap investing. Third one, how to identify a small cap stock, which probably is going to be becoming a multi-bagger in the future. And lastly, we will be talking about the different strategies for the small cap investing. So let's talk about what is this small cap stocks or large cap stocks or mid cap stocks. So it is according to the market capitalization. So for example, any stock which is having market capitalization less than 5,000 crores in India is called a small cap stock, all right, whose market capitalization is less than 5,000 crores. Any stock between 5,000 to 20,000 crores is mid cap stock. And any stock which is greater than 20,000 crores is going to be large cap stock. Now, there is further bifurcation in the small cap stock, that anything which is lesser than 500 crores market capitalization is extremely small cap stock, or they call it micro cap stocks as well. Fair enough. But we will be talking in general about some small cap stocks which are essentially not very established companies yet, and we are trying to invest in them. So what's the difference between small cap investing and large cap investing is large cap companies are the companies which have already proven business case with them. They have a business model with them, and they have tons of money, market capitalization. They have a lot of equity, and probably they have a lot of other financial resources as well. So their probability of failure is less. And the small cap companies are the companies which are still in the process of finding themselves, and probably they'll work out in the future, or they will get closed in the future. All right. So firstly, let's talk about the risk involved in both small cap companies as well as large cap companies. Generally, we take this curve, let's take this as the risk axis, and this is the reward axis for the investing. So generally, the large cap companies are going to lie in the low risk. This is the risk curve, okay? Generally, the large cap companies are going to lie in the low risk category, and the small cap companies are going to lie in the high risk category, apparently because they don't have a proven business model yet. All right, the small cap industry, the small cap companies. So on this whiteboard, I have represented the large cap stocks in numbers and the small cap companies in alphabets. So if you take the rewards, you will come across every kind of company in the market. For example, there is a large cap company which has low risk, and probably it has okayish reward or return percentage. Generally, 15% is achievable by any. If it is a good large cap stock, then over a period of time, you can easily expect a 15% CAGR from the large cap companies. Even if, for example, over here, 5 is not even giving 15% CAGR, it's giving 10% or 7%, which is equivalent. If it is given 7%, then probably you're losing money investing in this, because the inflation is going to be more than 7%. The nominal rate of inflation is going to be more than that of 7%. So just like a fixed deposit, or a PPF or an EPF, you are losing money in this stock if you are investing in this. So this is large cap investing, that you are investing like this. You are taking low risk and you are getting low reward also. Anything which is less than 12%, probably you're losing money because of the inflation, even in the large cap stocks. And initially, it is very tempting for the investors, new investors initially to go for the small cap industries, small cap companies, in which they want to invest. But most of the small cap industry companies are going to lie in high risk category. So what we have to do is if you want to invest in small cap companies, if you don't want to take large cap companies, we have already seen the positives of large cap companies. They have low risk, and if you are able to identify the 3 and the 4, which is not very difficult to identify, with a little bit of background in investing, you will be able to get 15% of CAGR return on probably on a lot of large cap industries which you have studied fairly. So, but let's come to the topic bullet 3 for today's. That okay, let's say that we are going for the investing in the small cap companies. We have to identify which companies we have to invest in. So this is the framework that you can identify. You can distinguish that who is A, who's B, who's C, who's D, and who is E. The ones that you have to avoid. So first and foremost, let's talk about the numbers and the fundamentals. That how do you identify that these are good companies worthy of investment? Is the companies which are high sales growth, generally greater than 25%, because initially if there is a very small cap company, it has to grow very fast. It has to capture the market share pretty fast so that it is able to sustain in the future. Not only cash flow wise, but competitor landscape wise also. So it's more than 25% is fair enough sales growth. If it is lesser than 25%, then probably it has more probability that it won't survive 10 years, 15 years down the line. All right. Although it's not guaranteed, but there is a high probability that it won't be able to sustain in a market where it is not growing. If it is growing at 10%, 12%, very less. All right, it should be having low PE, price to earnings ratio should be lesser. If it is price to earning ratio is greater, then it means it's a very expensive stock. Should not be having 80 or 100 PE, should be having lesser than 20 PE generally. Or it can have high PE, but even higher sales growth. All right, that if it is growing at magically 100% every year, then its PE can be greater, like 30, 40. But if it has a sales growth of, let's say, 25, 30%, then it's not justified that its PE is, let's say, 80 or 100. So high sales growth, low PE, no debt. Generally, in the initial phase, a lot of startups or the small cap companies, they can take a lot of debt and they can capture a lot of market share. They can incentivize customers to buy their products. It doesn't sustain in the long term. So as soon as the debt starts going on, debt starts withering away, then their sales growth comes down. Their margins are also coming down. And they were not making that much of profit. So that is a red flag for them. Then founder's background is very important. This is not talked about a lot in the investing world, but if you look at who is leading that small cap company, then you will be able to find out that whether it will be able to survive or not. As such, the companies are driven by the leaders. All right. If you have a weak leader for a company, then probably that company will not survive. Go through the leader's background, where he has or she has studied. What is his experience? Does he have the same experience as the product that he is trying to build? And does he have a proven track record? It may not be in the same industry, but if he was doing something else in some other field, was he a winner in that field or not? So one of the things that you have to look at is whether the founder's background is solid for this small cap company or not. Does he have his stake in the company? It should not be that he's leading a company of 1,000 crores and he doesn't have any equity in that. His equity in the company is just 5%. Promoter's equity is 5% only. then it doesn't have much incentive to grow the company or make it from 1,000 crores, probably make it a 10,000 crore company. Another thing is market share. Market size of the company. It should not be that the company is right now 10 crores and the whole market size is 100 crores only. So even if it grows, it is going to grow. Even if it takes the whole market share, then it is going to grow up to 100 crores only. And if you are investing at 10 rupees per share right now, then probably you'll be able to increase the share up to 100 on the higher side. All right, no company will be able to take the 100% of the market share as such, and probably they will not be able to survive for long. All right, so market size has to be really big. Even if the company is in that market share, even if the small cap industry is able to take 1-2%, then it is still going to grow a lot from its present position. Till now we have not talked about anything about the what is the current price, right? Because you will be looking at you will be looking at the Telegram channels or the WhatsApp channels or YouTube, that people will be talking about, hey, it has grown from 10 rupees, it has grown to 50 rupees, or 50 rupees, it has grown to 500 rupees in last 2 years. Now it is going to keep growing. It doesn't happen like that. That you just look at the price curve of the stock and you try to guess out what will be the price tomorrow. That is the job of chartists, which is, I don't know. I don't have really great words for chartists in the market. But this is a very lame way of analyzing a company. If you want to analyze a company, you analyze the company based upon its content. What is it building? What is its fundamentals? What is its balance sheet? How much money it has in his pocket, and what are they going to do? Not looking at the random charts of the price that, okay, if people are taking wrong decision, that you also keep taking the wrong decision in the future based upon just the price of the share. All right. One of the things that is not related to numbers is you will see a lot of advertisement of the small cap stocks on your whatever channel you're using, YouTube or anywhere else. If you're Googling, if you're doing any platform for investing in the shares, you will see that most of the stakeholders in the market pushing you for buying a particular stock. All right, avoid that. It's a red flag. For example, YouTube ads that this stock has grown from 50 to 100 now. Now it will be growing from 100 to 200. Generally, that is most of the time they are red flags, and probably you should be segregating those companies that, oh, I am not to invest. If they are calling you to invest, then probably you should not be investing in those kind of stocks. Because the simple reason is that if you're a small cap company, for example, I run a small scale business, and small scale business doesn't have that much money to spend on advertising or to spend on operators who can push your stock to the people to buy it. All right, they will be building their products. They will be servicing their customers. Their main focus should be, or their main focus of budget should be based for these things, building the product and serving the customers. If they are marketing their share, then probably their focus is not on their core business activities. If their focus today is not on their core business activities, then they are not going to succeed, or they are not going to forget about succeeding. They are not going to survive in the market. All right. So all the advertisements or all the operator-driven stocks, just ignore them. All right. They are not worthy. The small cap companies which you should be investing are the companies that are not visible. They are busy with their own thing. They are busy servicing their customers. They are busy working on their product, their operations. Those are the companies that will be lying right here. A. All right, and we have to identify them with a careful analysis. Now, even if with the careful analysis, you will not be able to, it is not sure that company A is going to be a high reward company. It is high. It is always going to remain a high risk. It might be a good reward company that it may not, you have invested in it for 2 years or 3 years, it may not survive because it's a high risk industry and probability of any startup or a new business going out of the business is pretty high still. All right. So that's when the strategy for small cap, choosing the small cap shares comes in. All right. So either you put all the eggs into one basket, that is A, and you invest in that company only. Either you can do that. Tomorrow that company goes out of the business, you're done. You are losing your investment. Another strategy is that you choose bucket investing in small caps. Now, you don't make a bucket like this, that you put all the small amount of money in A and B and the C and the D and the E and the F and the G's. Because at the end of the day, this is going to give you a negative reward, this is going to give you a positive reward, and probably in the end, your reward will be 0%. So you have to identify the A's and the B's and the E's in the small cap industry and invest small amount of money over here, money over here, money over here. So that even if B or E goes out of the business, then you are able to reap the reward from A and B. This is called bucket investing. Now, the bucket investing can be done within the small case, or you can do it a mixture of the small cap stocks and the large cap stocks. That some amount of money you put in the small case where you are expecting a high reward, and a major part of your investment portfolio is in the large cap and the small cap. Large cap and mid cap stocks, and small amount of your investment amount is in the small cap. All right? That is another kind of strategy. So I would recommend that you don't go for a single small cap. It is tempting to go for a single small cap, especially if you're being given a tip by somebody, or you see that A is growing like anything, and probably it will keep on growing. It doesn't happen like that. The horizon for investing should be 5 years or 10 years. Whether it is going to stay in the market after 5 years or 10 years is what you should be thinking, and you should be putting your eggs in the investing bucket accordingly. Even if you have a fair bit of conviction about A, that it is going to be a high reward, high risk company, still I would recommend that either you do the diversification within the small cap, or the diversification of the small cap with the large cap and the mid cap stocks. That's it for today. We'll meet tomorrow again for investing class, Investing 101.